Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our last EIA show of the year. We won't be filming next week, so it's been a good run. You know, we appreciate everyone's support. So if you haven't, please like, share, and subscribe. Tell your friends, family members, you know, whomever that you might think might, I don't know, find this interesting to some degree. So we have our three segments. In the first segment, we're going to talk about the U.S. You know, there's been some shifts globally with a lot of builds, but a lot of those builds are just crude coming off the water, crude coming out of transit. So it's less surprising, but we'll just go through what that looks like. The U.S. had a drop in crude storage, which is along the lines that should happen, especially when you look at PADD 3, because remember, in Texas, there's the ad valorem tax, which is why you typically have that drop as we go into the end of the year. But then we had a bounce in implied demand, which usually happens the week last week, this week, as people prepare for the push, because we do have Christmas this weekend, and then usually Christmas and New Year's, you want to make sure that there's enough product. But then in the next segment, in the second segment, we're going to go through how even with this bounce, it's still very weak, and we're going to look at it against historics. Why could it be weak, and really where does it go from here? And then in the last segment, we're going to look at how the physical market has weakened again. There's some concern in terms of where some of the flows are in the physical market. You know, especially when you look at West Africa, we've had another round of OSP cuts, and it just really points to another round of cuts coming for OSPs from Saudi Arabia. And we want to look at Middle Eastern floating storage, because even as floating storage has gone down in other places, it still remains elevated and actually had a big, fairly sizable increase this past week. So with that being said, jumping right in, here you can see what we were talking about with total oil and product stockpiles. So it flipped from a surplus, it went from negative 6.5 to a positive 25.1. So you can see that we're at the high end, even against the historical range between 2017 and 2019. You can see that we're actually breaking above that, which is interesting. But you can see realistically from here that it's supposed to go up. You know, the question is, we're just going to really be at the high end of that cloud, but by no means anywhere outside of what has happened in previous years. So it's not anything crazy that's going to send crude down to 40 in the near term. It's just something that's very stable, just at the high end of the range. And then when you look at total crude stocks, land and floating, you flip to surplus, went from negative 3.1 to 15.5. And a lot of that was just driven based on, there's still a lot in the floating side, but some of that is transitioning into land storage, as we do have a fairly sizable drop in crude in transit, but we'll talk about that a little later on. And then total oil product stockpiles flipped to surplus from negative 3.4 to positive 9.7. That's something that when you look at where we are on the total crude, land and floating, you can see that we're just at the high end of that range. You know, we're just above where we were 2017 to 2019. And then when you look at total oil product stockpiles, we're actually right in the average from 17 to 19. And a lot of that is being driven by fuel oil. There's been a lot of softness and a lot of volume really in the high sulfur, low sulfur, very low sulfur diesel, still very much in short supply, still a lot of demand, but it's the higher sulfur stuff that is continuing to build up, as well as gasoline, as we said. Now, the Platts put out a good breakdown, and Big Oren was kind enough to retweet it. But Saudi Arabia, when you look at refinery cracks, and I think the margins are really important, because Arab Light is at 498. Bonnie Light is at 1559, and MEH, which is Magellan East Houston, is at 1412. So when you're looking at it, there's no reason why you would take Arab Light if you could take some of these others. Singapore, Arab Light, 489, ESPO, 2442, Dubai, 904. So when you look at the shift, it's like, well, what's the impetus to take Arab Light? ESPO, we know, is going to be cheap. Russia's obviously pushing that in. the question, and then Dubai, but then Italy, Arab Light, 579, CPC 2038, and MEH 937. So as we've been talking about the increase in CPC, that's going to be, well, if you're in Italy, if you're in Europe, well, you're going to take as much CPC as you can. You're going to take as much MEH or really US crudes as you can, because Arab still isn't competing, which is why we talked about, I think it was 2 or 3 weeks ago, how we expect Saudi to cut again. They're just not competing in this market. It's Asia, in Europe, in the US. We did get the U.S. bringing in some additional cargoes on the Saudi side, but in order to get a meaningful drop in floating storage, which we'll talk about in segment 3, you're going to have to see another cut in pricing. So now when we look at land storage, here you can see that the deficit narrowed from 56 to 38.1. We're closing the gap, and we likely will continue to close the gap as we go into year end. Land storage west of Suez went from a deficit of 38.4 to 26.6. East of Suez continued to close the gap from 14.8 to 8.3. And as we get more of that crude from transit going from transit to floating storage to onshore, as that gets more streamlined, which it will as we get into year end, especially because shipping rates are still high. Now that things are starting to normalize a bit, especially in China, you should start to see some of those cargoes move quicker, which will push more into land storage. Floating storage total flipped a deficit from 26.3 to negative 6.3. West of Suez flipped a deficit from 6.6 to negative 7.3. East of Suez, surplus narrowed from 15 to 3.2. So this is 2 weeks ago. It's actually still remains fairly heavy. There has been some fairly down. Is still some when you look at where we are in floating storage and transit. There's been additional conversions from transit to floating storage, but you can see we've just moved closer to, again, that 2016 to 2019 average. We should get a little bit, again, as that transit, as it goes from transit or from the water onto floating storage, that'll pick us up a bit. But again, you're seeing how there's that speed in which we're getting things off the water now. That's starting to normalize, and that's starting to move things back on land. When you look at the crude draw, we had a draw of 5.9 million. That's 52 million below the 5-year. And again, it was driven by Pad 3. Pad 3 was down 4.57. That's just 5.9 million below the 5-year, right in line with the year over year. And we'll show the chart for Pad 3 in a moment. It happens every time this year. Again, it's all about taxes, trying to bring that down. And then as we get into January, that will reverse. Midwest, small build of 0.2. Cushing, small build of 0.85. And when you look at what happened with Keystone, that'll continue to be a lot of pressure there. We don't see that changing in the near term. Just because the pipeline, the section that was damaged, has been removed. Now you have to put it back in place. There are some workarounds that they're using, but you're not going to get full volume. So again, that's going to continue to be an overhang. Aggregate with SPR was down a draw of 9.54 million. So I actually tweeted it out the other day, where in the spending omnibus that is supposed to come out to bridge the gap for spending, it's going to stop all sales from the SPR that were supposed to happen between 2024 and 2027. Because if you remember, there was a bill passed where they were going to sell down crude straight through 2027. But now with a lot of the SPR sales that have happened, they're essentially saying, look, we pulled all that forward. We don't need to do it now going into 24 into 27. So they could actually be a buyer. They were out buying a bit. And then if you remember, the first tranche was actually lent out. So some of that crude will start coming back as we go into next year, depending on the term that you took, because there was an option of 1, 2, or 3 years. So that's also going to bring some of that crude back into the SPR. Crude oil inventory, as you can see here, moving along that seasonal line. There's typically that drop down that normally happens, especially if you look at the bottom half where the essentially the other 20 years are. You can see that there's typically that drop as we go into year end. It's not something that is new, so not too much. We expected to, as we said, I think it was 2 weeks ago, we expected to close really right around where we were last year. Not too much change. Cushing starting to creep higher. Obviously, the loss of Keystone is going to impact that. So we actually think this is going to close right around this section. Things will slow down as we go into this week is really the last push, and then you'll have a really slow week next week, and then things start to pick back up as we get into January. Runs were down to 90.9, down 1.3%. You can still see that things are fairly in line with historics. Pad 2 had a drop of 112,000 barrels a day. A lot of that was just runs getting pushed down because there were some pressure on margins. Then you had the issue with availability of crude from Keystone. So that's something where there's typically a slowdown. Usually it's this week. So there's hasn't been a lot of demand. There's been some decent storage that has come into, especially on the gasoline front. So makes sense given what happened with Keystone, shut things down a little bit earlier, and then bring things back up in January when a lot of these things have been repaired. Weekly U.S. imports of European gasoline, increased. We're going to talk about that in a minute, just because there has been a little bit of an increase, and it's only because the amount of gasoline in Europe is sizable. This is just looking at it against the last 29 years. We just wanted to look at the average. You can see that there's normally a drop. If you zoom in a bit, you can see that there's typically a drop. But as I was saying before, it's usually because remember, EIA is talking about last week. So really what the drop that normally happens is this week. It just happened ahead of schedule. We don't see it going below the 29-year average, very much stable as we go into the new year. Then when we look at imports had a big drop of just over 1 million barrels. That's 927,000 below the 5-year. And it shouldn't be a surprise that Pad 2 was the one with the big drop. That's going to stay the case just because when you look at the capacity in general, a lot of that is being driven by the loss of Keystone. That is just going to reduce the amount of inflows until that normalizes. Pad 3, small, but as we were saying, it's going to remain sluggish just given where we are in timing. And then Pad 5 continues to be lumpy. That's something that obviously should reverse a bit, but you might get a delay or a lag. Even if you don't get a lag on the actual import, where you could say as you could be sitting there saying, well, I saw that barrel unload. Remember, there is a lag in the paperwork, and it doesn't have to be filed immediately. There's usually a 2 to 3 week window to submit it. So again, that usually increases lag time because, let's be fair, most people are checked out either physically or mentally at this point. When you look at Pad 3, as we were saying, steady at the low end. We don't see too much movement up or down in the very near term. Pad 2, sizable drop. We'll get a little bit of a bounce, but again, we're going to stay well below the 5-year until that Keystone pipeline has been repaired. When we look at implied demand, gasoline had a pop of 459,000 barrels a day to about 8.7. Again, we talked about this last week. Here it is. It's still well below the 5-year. We don't see it crossing that line. Because remember, when you think about implied demand, this is in head of driving, because implied demand it's going from the storage tank in the racks and in the refiner to the end user. And this is getting it into tanks ahead of people going out and driving for the holidays. Distillate had a pop to about 4 million, pretty much in line with our view. We do see some weakness coming now just because diesel demand is down on the trucking side. It's obviously gotten very cold, so you will get a little bit of that refill, but we do have a bit of a warm-up coming, which will help offset that a touch. Jet still remaining high. That'll stay high this week as well, and then you'll see a sizable drop-off just as we normally do for travel. And propane, propylene, big pop of 610,000 barrels. in line with our view that as things got really cold, you're going to see a big increase in propane, propylene demand, and then that'll drop off as well. But still, and realistically drop off below the 5-year average again, even as exports continue to stay strong. When you look at gasoline here, we're above where we were in 2021, but you can see just how far we are from quote unquote normal. We don't see that adjusting all too much. No, I'm sorry, not 2021, 2012. You can see we're right around where we were in 2012. You just get an idea of how far down we are, and we just don't see that adjusting. We will get another increase, but by no means saying that we won't. Our view was anywhere between 8.8 and 8.9 is going to kind of be that top. And then we'll come back down to what we think is closer to the normal of about that 8.5 million barrels a day as we go into next year. When you look at crude oil inventory, excluding the SPR, we're just going to continue to move close to where we were in 2021. The problem is going to be imports, especially into PADD 2 with Keystone down. So we could be a little bit on the lighter end just because of that. And then we do expect that to cross higher as we go into the new year. Then when you look at product, oil and product, you can see we're right at where we were in 2021. And as we've been saying, we don't see that deviating, especially because gasoline builds continue to mount. We don't see that slowing. We do expect to see one week where it's probably flat, slightly down, but it's still going to continue to build. And then PADD 3 continues to build on the distillate front, again, as they're moving that crude around. But we do expect to close out the year close to where we were last year. Days of supply for crude, again, fairly normal, moving in that typical direction. We don't see too much deviation. Gasoline storage continues to climb. As we were saying, there's usually a little bit of a pause, whether it's flatter, just a slight pop, but just a rate of change adjustment. But you can see that we are going to close out the year towards the high end of that normal scale. And a lot of that, when you start looking at distillate flatlined, we don't see that adjusting too much just because imports have slowed a bit. And we do have exports increasing pretty sizably into Europe, which is going to keep us fairly flat. Jet, same thing, is going to stay fairly, what's the right way? Neutral at this point, just because there's not too much happening, and they're going to try to preserve as much kerosene into the distillate pool, just given price. And then when you look at futures, you can see that there's slight contango right now, but you can see that it's flatlined a bit, and a lot of that is because the front month has strengthened, not so much because the back end has weakened. The curve. But when you look at it versus especially 2 weeks ago, you've had a big response in the front month, but again, pretty much neutral going through the curve. We see one more push to 80, and then we'll likely drop off a bit and settle closer to about 75 after we get to that little touch, because there is some resistance between that 80 and 82. And again, crude is its own beast. It usually accelerates to the upside, or I should say overshoot to the upside, overshoots to the downside. So 80 is kind of that spot where you have some decent resistance. 76 is then when you have 78 is where you have the next support, and then 76. But we do think it'll after that last push, you'll have a little bit of a drop. Just a lot of volatility, which we think actually is going to only increase as we go into next year, if you can believe it. But we're going to talk more about that in segment 3. But in the next segment, we're going to go deeper into what is happening in U.S. storage and demand. And here's when you look at the floating Gulf Coast, things are fairly flat. We don't expect this to adjust all that much. If anything, we get one more spike in floating storage in the U.S. just because we get one more spike. Companies keeping things offshore. And then the moment we click into the new year, a lot of that will draw down, just again, trying to avoid those taxes. So that's what we have for you on this side. Next segment, we're going to go deeper in the U.S. and refined products.